It's a company called National Tyre. It trades under the ticker code NTD, sometimes called National Tyre Wheel or NTAW. It's an interesting business. It's probably not what you think. When people think of tyres, they think of Goodyear, Bow repairs and getting their car serviced. This business is primarily a distributor of tyres. So it imports and then on-sells that to retailers. It does have its own retail arm called Tyre Wheel, and it recently made an acquisition of another business called Carters. So these are like business to consumer, B to C, but typically it's B2B. And the business has grown largely through acquisition over the years. What's really impressive about National Tyre is it's maintained its cash flow in that time. It's used some debt, it's used some equity, but it's grown its business acquisitively. And when it makes these acquisitions, it actually brings on the founder or the CEO typically, which is a good move for the business. And it reminds us that these people want to stay around. These people run these businesses. One of the hardest things when you make an acquisition is the culture and the integration. And they've done a pretty good job of that under Peter Ludeman. The business has consistently reported incremental revenue as a result of these acquisitions. But it's also, over the past 2 years, had some favorable, extraneous variables. So things like currency movements in the right direction, good import-export environment. But what we're seeing now is probably a reversal of some of those things. So we've seen it make these acquisitions into a pretty good market, and it's established itself as Australia's largest independent tyre distributor, and also bringing in that retail arm. I initially thought when they acquired the Tyre Right business, I think it was part of Tyres for You, I thought that they would actually spin that off, but what they've decided to do is actually make that a franchise model, because it's not their core competency, while they focus on integration and building out this IT backbone. Basically, the business went through this period where it was really dependent on Cooper's tyres. That includes the Mickey Thompson brand. So people were really concerned when that contract, I think it was Goodyear, bought Cooper's, and they were really worried about that relationship, how that might sour. But basically what National Tyre and Wheel has done is basically said, okay, well, we're just going to grow out of this. We're going to grow so big that, all of the tyre suppliers and manufacturers have to work with us, and we have to be able to push that through our network. So by building itself out vertically, then also having some distribution footprint to the consumer side, and also dominating things like mining, forklifts, agriculture, it's basically like entrenched itself in the ecosystem in Australia. There were a few things that stood out from the recent results. It is experiencing higher import prices because of the weaker Aussie dollar, and the rubber costs, I believe, are up too. So there's a material cost there. Shipping costs, we all know, have gone up through supply chain bottlenecks and so on and so forth. I would expect to see higher inflation in the second half hitting some of those wages. That line item for wages that they have, while they are ripping out some cost due to synergies, that we'll probably see that go higher. They increased in response to, and this has been pretty common across the industry actually, in response to supply chain issues and inventory, they've dramatically invested in their working capital. So their cash flow isn't looking quite as crisp as it normally is. The shares fell about, I think off the top of my head, about 20% on reporting day. So one of those big volatile ones that you were talking about on the downside. Some of the things that they can do, however, now that they've made a number of these acquisitions of Tyres for You, Black Rubber and Carters, is they can use their own network to push their own volume through, which they haven't been able to necessarily do in the past. So say if they have the retail arm, they can fill shelf space with their own inventory, and they can start to push that through there rather than be beholden to retailers and just getting what the manufacturer sends. So there are many organic levers that they can pull now. I think some of the concerns might be around, well, hey, in the past you said you're going to make all these acquisitions, and now all of a sudden you've shifted to, we're not making acquisitions, we've got debt on the balance sheet, we're going to go in a different direction and focus on the organic side. I think it's the right time to do that. I think they should be doing that right now. I think the move to kind of diversify the Tyre Right business and focus more on their distribution is really interesting. They made an acquisition of a company called Black Rubber, which I'm not sure how much you know about tyres, mate, but I didn't know a lot before I got involved with National Tyre. But one of the things that they can do is they can actually do deals like kilometres. So they can price tyres and form enterprise kind of wide or company wide deals with fleet companies and whatever to basically charge a fee on like a per kilometre basis, which is really interesting for tyres. Electric vehicles, by the way, also use rubber tyres. So just in case people are wondering, what's electric vehicles going to do this? But what they can do is through their retreading business, they can now push all of their network through the retreading businesses that they bought, which lowers costs and allows them to share that IP across the teams. The company pays a dividend, but obviously that's dependent on cash flow being stable over the next 24 months. I think it should be stable, but fully franked, good dividend. I used to, when I did a valuation on this, I actually used a 15% discount rate, which is probably fair. Maybe you could go a little bit higher, maybe a little bit lower, depending on your view of the risks from the macro, and a 1% terminal growth rate. And I think it's still reasonably priced at these levels, even if you get a decent dividend and modest compounding. I think Peter Ludeman, who has, if I'm not mistaken, AMP Capital background, really good capital allocator, seems to be strongly aligned to the business, and lots of those founders still entwined with the business too. So National Tyre, it's not without risk. It's a bit of a hairy one. It's one of those kind of acquisitive roll-up / really deep value plays. You have to do your numbers carefully, but I think it's an interesting one, at least for the watch list. And as we see this next 6 months play out, just keep an eye on those wages and basically how those costs expand. We want to see those under control. But NTD is the ticker code. Interesting business, offers yield and modest growth. I think that's number 4, Luke. So now we've got one more. And this company that you're about to bring up is a company I think I looked at, and the irony is I think I looked at it when you and I may have been on Ausbiz together for the call at lunchtime one day, and I didn't know anything about it. And I did a little bit of cramming for the show. And now I still know that little bit about it. So I'm hoping you can fill us in on what Earlypay does. EPY is the ticker code.
Just quickly on National Tyre, I like the business, and I think it's in the right space. Distributors can be brilliant businesses, particularly in that nice little niche. And I think I agree with a lot of your comments there around the key to a good distributor is a very competent management team. And I think these guys have been listed long enough and being through COVID to demonstrate that. And more importantly, I agree with your point on the balance sheet. I had a quick look. I think it's sort of at a level now that's comfortable. It's about 1x net debt to EBITDA. You could probably, if they found some aggressive lenders, you could probably take that to 2. But I think you're right. I think this is the right time to now squeeze what you've acquired and get those organic synergies. And it's one that, I pretty much agree with everything you said. It's got some risks to it, but for the right investor, I think you've got a good management team at the helm to sort of steer that ship through them and do okay.
Yeah, it's all about position sizing, rather,
exactly.
with something this size. So yeah, it's not without risk, as I said, but it's a really interesting play for yield and maybe some modest growth as well. Just keep an eye on those extraneous factors, I guess.